Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Matt Crawford and Nimesh Shah.
Welcome to The Tax Factor. I'm Nimesh Shah, CEO at Blick Rothenberg.
And I'm Matt Crawford.
Fresh from Matt's groundbreaking appearance on GB News, being interviewed by Jacob Rees-Mogg. Matt, I am in awe of the media celebrity that's across the Tax Factor microphone this week. But more on that in a moment, because it is now less than 3 weeks until the budget. And since the Tax Factor's been back from its summer break, we've had a story every day almost about what may or may not appear in Rachel Reeves' budget. And it's been real media overdrive over the last few days, where there's been stories of watering down on CGT reform or non-DOMs or even pensions as well. But we're not that far away. I think we're all rubbing our hands as to what is going to happen in 3 weeks' time. And I will remind everyone, I will be on holiday that day. But before we get into some more budget speculation, as is a favourite of the Tax Factor, Matt, I've got to ask you about what it was like to go and meet Jacob Rees-Mogg. What were you talking to him about?
So I had an absolutely cracking time on GB News with Jacob. He was interviewing me all about whether or not gifts to politicians such as the glasses and the suits from Lord Ali to Keir Starmer should be subject to tax or not. And he was at pains to try and make me say the answer should be yes. My view is the law as it currently stands is absolutely not. They are simply gifts. But I have got a view that it would be much better if maybe there was a sensible threshold of say £2,000 or £3,000. Over that, any gift connected in any tangential way with your employment or office or profession should be taxed. And then you wouldn't be in this ridiculous situation where people are having to pay tax through things like the PSA and on P11Ds on benefits in kind worth £50 or £60 for employees. So I think it'd be a much better thing to have a threshold for that. But yeah, we had a really good chat, really enjoyed it, albeit I was a bit nervous in the green room for the 20 minutes beforehand doing my first live TV interview.
Matt, you've had some great feedback from your interview, and I thought you did really well with those difficult questions from Jacob Rees-Mogg. On the other side of the opposition these days, and interestingly, I can imagine that the Conservatives, when they were in power, would have got their fair share of donations as well, but maybe that's something for another day. But speaking of the Conservatives, though, we want to be balanced on the Tax Factor because we did cover the recent Labour Party conference, but the Conservatives have been in action as well. It hasn't had that much attention in the media because I think it's all been dominated really by the budget, but there is a leadership contest going on with the Conservatives, and I think the candidates for the leadership contest took the stage to really talk about what they might do on taxes. And a few things stood out, didn't they, Matt? Albeit they got a bit unnoticed, but what did you spot from the leadership candidates thinking around taxes?
Well, I guess the first thing that's really important to say is we're recording this probably at the exact moment that one of the people we might be about to be talking about gets eliminated from the race. So apologies if you're listening to this and we're talking about a candidate that's no longer quite as relevant. But one of the things that really struck me was James cleverly saying that people shouldn't be paying tax at more than 50%, a marginal rate. That's a proposal I must admit I entirely agree with. But a more eye-catching one, I think, was the proposal to completely abolish stamp duty land tax. Now, that's something I've always advocated for. I'm a great believer in it. Personally, I would fund most of that by abolishing principal private residence relief on private home sales. But my view is also that that's electoral suicide to do so. But I think it would definitely be the way forward as far as I'm concerned. So I quite liked some of those proposals, I must admit. What did you spot, Nimesh, that you liked the look of?
I was going to say, Matt, despite your amazing appearance on GB News, I don't think anyone's going to vote for you if you're about to abolish principal private residence relief. But I can see a case for abolishing stamp duty land tax as well. It's a horrible tax. It is viciously complicated now as well. It was more straightforward when it was introduced many years ago, but doesn't encourage social mobility. It's expensive now. It's difficult, albeit it does raise quite a lot of revenue. So it's difficult for a government to abolish it completely without something in its place. But this is a little bit of hot air at the moment. I think there's a reason why the Conservative conference didn't get too much airtime, because it's unlikely that the Conservatives are going to be back in power, probably even at the next general election, given the defeat that they had. And it's still very much up in the air as to who is going to be the leader of the opposition. But Kemi Badenoch, who had a role around business in the last government, she's talked about reducing corporate taxes and reforming CGT. She's saying that wealth shouldn't be considered a dirty word and we shouldn't be thinking about lots of taxes on wealth. So she's pushing the envelope on a big reform of CGT. Someone else who's pushing a big reform on CGT also is our friends at the Institute of Fiscal Studies, because they released a very lengthy report, which I had the pleasure of reading on my journey home yesterday, around what they would do if they were the Chancellor standing up in a few weeks' time. But Matt, you've had a chance to read the IFS report on CGT, some interesting things that they've had to say about CGT, not all of which I happen to agree with, but what's your take on it?
First of all, some of the interesting things I found in there actually is just some of the statistics around how much CGT actually raises. So it raises around 15 billion per year, around 2% of the total tax revenue. And the other stat in there that I thought was really quite interesting was that 3% of CGT payers realise gains of more than $1 million. And that group accounts for about 2/3 of the total CGT revenues. I found that the disproportionality of that really quite fascinating. But one of the things that they were basically saying is that there's a strong case for reforming the tax base, but they want to try and align more the capital rates with the income tax rates. And they could achieve that, I presume, by a very small percentage drop in income tax and NIC rates and a significant increase in the rates of CGT. Now, my view on that, to be honest, is the problem is I just don't think anyone would notice that very tiny drop in employment income tax rates or trading income tax rates that you've managed to fund. So, yeah, I'm not convinced by it either, but I know you've got some views on it too.
Yeah, the IFS suggested that if you do align CGT and income taxes, they'd give you this upfront deduction for the investment in the first place. So they're saying that we'd give an upfront relief or an upfront deduction against your income to incentivize more investment and entrepreneurship. But then when the ultimate realization happens of that investment, you're taxed on the full amount of proceeds. So you're gaining some relief up front. I found that really difficult. Maybe it's because it was the end of the day and I was on the train home and I just got caught in the pouring rain, but I didn't quite get my head around that upfront cost deduction, really. That sounds really, really complicated. They also talked about a form of exit tax, albeit they're not allowed to call it an exit tax, really. But what they were saying is that when someone moves to the UK, they come with their historic base cost of their assets, even though that asset would have appreciated in value over a period of time of which had nothing to do with the UK. So you should get an immediate upfront market value uplift when you come into the UK at the first time. Sounds actually quite sensible, because what a lot of people do is they try and create artificial disposals before they do come into the UK so that they have a higher base cost going forwards. But that doesn't happen on the way out. On the way out, you can leave the UK without any tax penalty in inverted commas. Other countries like Canada, for example, there's an exit tax mechanism there where you have a deemed disposal of your assets when you leave Canada, and you have to then work out a valuation with the Canadian authorities, and you can decide whether to pay that tax up front or defer it because you haven't had any cash to go and pay that tax. And so the IFS is saying, well, we should have something similar. We should have a deemed disposal of assets. And they believe that that's only fair, that if you've built up value during your time in the UK, that you should pay some tax on account of that before you go and leave. Now, my view is that I think it discourages people setting up businesses in the first place. If you're going to be clobbered maybe with an exit tax, you may want to go abroad for good reasons, not just tax driven. I also think it discourages people from coming to the UK as well at a time when we're opening the door really on foreign investment and talent. Certainly has been the positioning of the new Labour government. So I think I can see where the IFS is going with this. I think it's probably a step too far for the 30th of October budget. I don't think Rachel Reeves will have as much time as I do to go and read through the full report. But we are suggesting that, or there's certainly rumours in the market that CGT is about to go up significantly. I don't think it will go up as high as income taxes. And I think it's a stretch too far on some of the proposals in the IFS just at this stage. And I think the other thing that I spotted as well is Stuart Adams at the IFS, who I've got a lot of time for, and I've been on a few panels with him over the years. He was quoted in the papers this week as saying he felt that the exodus of entrepreneurs and individuals individuals and millionaires out of the UK has been overstated. Again, I'm not quite sure where Stuart Adams has got that from, but my experience has been that pretty much every entrepreneur has been talking about their options on leaving the UK because they are very worried about CGT going up from 20% as high as 45% income tax rates, and they don't want to be clobbered for double taxation on a business that they've built up over many, many years. It's a conversation that's happening a lot. Not many people yet have executed it, but I think they would do if they find that CGT goes up dramatically. And then on the topic of non-residency, there's been a brilliant article by our colleague Matt, Melissa Thomas, who spotted an issue with a cruise ship. And there's a tax angle with everything, and certainly when it comes to Melissa as well. But your thoughts on the cruise ship and people buying these tickets for so many years? What's been going on there?
Yeah, so this was Melissa wrote an absolutely fantastic article all about this cruise ship that was stuck in Belfast for some period of time. And of course, people may well be on that cruise ship for 12 months, 24 months. I think it was even possible in some cases to buy a ticket for up to 15 years in certain cases. And that potentially poses a huge problem from a taxation perspective. These individuals are likely to be non-resident in every jurisdiction. Currently, tax treaties don't consider what happens when you have people that are on these types of cruises. If people are working from those cruises, which they might well be doing either under a self-employed arrangement or maybe have some form of side hustle, it will be very difficult to work out where that should be taxed. In the case of this rather long stay in Belfast, it's entirely possible that people will have been working from their laptops from the cruise ship or their hotel in Belfast during this time, might not have become UK resident, but will still have to pay UK tax on their UK work days as a non-resident. And I think many people will forget to file. So I think it's a fascinating issue. And I can see a scenario if more and more people start doing this and these cruises become more common, that jurisdictions might have to come up with a regime, maybe a little bit like the non-resident entertainers withholding regime. It would be sort of the non-resident cruisers regime, that some form of withholding tax or something when you're dealing with that sort of problem. Because if it happens more and more, it's going to be very difficult for governments to know how to stop that tax base eroding.
Yeah, there's always a tax angle here, isn't there? And I can see in the world of more mobility and people maybe retiring a bit earlier and higher taxes, that these cruise liners could badge themselves as legitimate tax saving schemes, because the UK fully accepts that someone can be completely nomadic for tax purposes, but you need to watch out for if you do get stuck because of engineering problems, what may happen if you're stuck in a particular port and getting stuck then in a high tax jurisdiction. As Melissa was saying, she can't really see at this stage HMRC opening a naval division at any time and having tax inspectors going around these cruise ships and making sure that people have filed their self-assessment tax returns or not. But one HMRC inspector, or former inspector, I should say, may be eyeing up one of these cruise ships, Matt, because the CEO of HMRC, Jim Harra, is about to retire. And I didn't realise until I saw the press release, but he's been at HMRC for 40 years. That is some stint. What do you think of Jim Harra's tenure as CEO, and what are the good things that Jim's been doing?
So I would say some of the best things he's been doing are in the digital space for easy queries. I think that's been revolutionary. Basic questions to HMRC through the portals, I think, are excellent. Some of the online forms that we've got now really are working an awful lot better. I think where an awful lot more could have been done is in training of people and allowing agents to get through to people for those difficult questions where the online tools simply don't work. I think in that respect, HMRC's really gone backwards under his time at HMRC.
No, I think that's really fair, but a very well-deserved retirement for Sir Jim Harra, I should say. And whilst he's come in for some criticism more recently about the phone lines and the inefficiency of HMRC, I think there's been some cultural challenges that he's had to put up with. But God, he's taken them through some immense change and having to contend with change from government as well. So very well-deserved retirement for Jim Harra. And Matt, there's a job opening going now at HMRC, which I've seen advertised on the civil service website. So if you're up for it, rather than media celebrity at GB News, I can see Matt Crawford, CEO of HMRC. It's £200,000 salary, or up to £200,000 salary, but also an eye-watering, very attractive 29% employer pension contribution. Before we go, Matt, one final word on salary sacrifice pensions. If you are going to apply for the CEO of HMRC, what may happen in the budget around salary sacrifice pensions?
So it's really quite likely that salary sacrifice pensions won't be as attractive anymore, because instead of it being the case that employers' national insurance won't be payable on those contributions, it would be a really easy thing for the Chancellor to do, to say that they are all subject to NIC, just like they are with many other benefits in kind. So yeah, that's something I would expect that to happen in this budget.
Yeah, so if you are thinking of applying for that job, you may want to negotiate a slightly higher salary increase on account for not having as much benefit in your pension going forwards, if the Chancellor has anything to do with it.
The Tax Factor from Blick Rothenberg.
That is all we have time for this week. Thank you very much, Matt, for taking us through everything and sharing your experience at GB News. We release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen whenever it's most convenient for you. We record and release them in less than 24 hours, so you always get the latest news and updates. If you've enjoyed the podcast, please subscribe and give us a rating or review.
Next week, Roger Holman and Rohanna Earl are presenting The Tax Factor. We've also just released a new episode of our sister podcast, Brave Business, presented by Declan Curry. This episode is all about the business case for sustainability. Everyone talks about it, but what do you actually do beyond all the cliches, and how can you prove that you mean what you say? So joining Declan this week are Jim Brown from Blick Rothenberg, Charlotte Pumford from Vivo Barefoot, and Paul Lewis from Seismic. It's well worth a listen to see how businesses, including our own, are approaching this topic. Like The Tax Factor, it's available on all podcast platforms and our website. Next week, Roger Holman and Rohanna Earl are presenting, but from us, it's goodbye and have a good weekend.
Goodbye, everyone. Thank you.
That's The Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts, and join us again next time on The Tax Factor.